The electric vehicle market is on the brink of collapse. Despite all the hype, the reality is setting in. Stagnating sales, soaring running costs, and legacy automakers retreating from their EV ambitions. The dream of an all-electric future is rapidly unraveling, and it's clear that the EV revolution might be over before it truly begins. Welcome to the beginning of the end for the EV market, as we discuss some of the signs that the EV market is done. Stagnating sales. Let's start with one of the reasons why the EV market might be on the brink of collapse, which is the stagnating market growth. So, firstly, let's talk numbers. The rapid growth in EV sales we saw a few years back, that's history. The hype was real, but the reality is hitting hard now. Sales are slowing down, and in some places they're even declining. Take China, for instance, a major player in the EV market. China's demand for EVs has taken a nosedive. That's a big deal because China was supposed to be the golden goose for EV manufacturers. Companies like Tesla had banked on China's market to keep their sales booming, but now, with demand drying up, those dreams are quickly turning into nightmares. Why is this happening? Well, several reasons. One, the novelty of EVs is wearing off. The initial wave of early adopters has already made their purchases, and the broader market isn't as enthusiastic. People are realizing that EVs come with a host of issues. High upfront costs, limited driving range, and inadequate charging infrastructure are just a few of the headaches that potential buyers aren't willing to deal with. Moreover, the economic situation isn't helping. Global economic uncertainties and rising inflation mean people are tightening their belts. Money is tight, shelling out a premium for an EV is just not a priority for most folks. They'd rather stick to their reliable, cheaper gasoline cars than gamble on an expensive, unproven alternative. Tesla, the poster child of the EV revolution, is feeling the pinch. Their massive investment in production capacity in anticipation of ever-growing demand is starting to look like a misstep. With demand stagnating, they're faced with overproduction and underwhelming sales. This isn't just bad news for Tesla, it sends shockwaves through the entire EV industry. If the biggest player in the game is struggling, what hope do the smaller ones have? Customer hesitance. Next, let's talk about why customer hesitance is another nail in the coffin for the EV market. When people aren't willing to buy EVs, it's a clear sign that things aren't looking good, and surveys back that up. A significant percentage of people just aren't ready to make the switch to an EV as their main vehicle. They're open to the idea of EVs in theory, but when it comes to actually buying one, not so much. They cite the high costs, range anxiety, and overall inconvenience as major reasons for their reluctance. Moreover, the resale value of EVs is another big concern. Traditional cars generally have a predictable depreciation curve. With EVs, the situation is murkier. Batteries degrade over time, and the technology is evolving so rapidly that current EVs bought today might feel outdated in just a few years. This uncertainty makes people wary of investing in an EV, as they fear it might not hold its value. High running cost. Another big reason why the EV market might be on its last legs is high running costs. Remember when we promised that EVs would be cheaper to run than traditional cars? Well, it turns out that reality doesn't always match up with those rosy promises. First off, let's talk about electricity costs. The idea was that charging your EV would be cheaper than filling up a tank of gas, and for a while that seemed true, especially if you had access to a home charging setup. But now electricity costs are on the rise, especially at public charging stations. Those stations charge a premium for the convenience, and that can quickly add up. It's not uncommon for the cost of charging at a public station to be higher than you'd expect, making it less economical than driving a traditional internal combustion engine vehicle. Public charging isn't just expensive, it's also less efficient. Fast chargers, which are the most practical for people on the go, often come with higher rates. Plus, not all public chargers are created equal. Some are slower, some are unreliable, and finding a working one can sometimes feel like a treasure hunt. This inconvenience and added cost makes the whole EV experience less appealing. Let's not forget about the maintenance costs. While it's true that EVs have fewer moving parts and theoretically require less maintenance, the reality can be different. Battery replacements are insanely expensive. As the battery ages, its performance degrades, and replacing it can set you back thousands of dollars. Other specialized parts and repairs can also be pricier because they require technicians with specific EV training. So, When you add it all up, rising electricity costs, expensive maintenance and repairs, costly home charging setups, higher insurance premiums, and poor resale value, it's all clear that running an EV isn't the cost-saving paradise that it was once made out to be. China's oversaturation. China is the largest EV producer and is currently grappling with a situation where production capacities are far outstripping domestic demand. The result? A market that's overflowing with EVs and no one to buy them. First, let's break down the oversaturation problem. China went all in on EV production, anticipating a future where every household would be clamoring for an electric car. But that future hasn't quite materialized. The initial surge in demand was exciting, but now the market is saturated. There's simply too much supply and not enough demand to keep up. Factories are churning out more cars than the market can absorb, leading to a glut of unsold vehicles. This oversaturation has led to intense price wars, with too many manufacturers competing for a limited number of buyers. Prices are being slashed left and right. And while this might sound like a good deal for consumers, it's a disaster for the manufacturers. These price wars erode profit margins, making it difficult for companies to stay afloat. Smaller players are particularly vulnerable, and we're already seeing signs of financial strain across the industry. To make matters worse, Chinese EV manufacturers are struggling to offload their excess inventory into Western markets. Protective measures and regulations in countries like the US and Europe make it hard for Chinese companies to penetrate their markets. Tariffs, stringent safety standards, and a general preference for local brands are significant barriers. Western countries are keen on protecting their own EV industries, and they're not making it easy for Chinese imports to gain a foothold. The struggle to enter Western markets means that Chinese manufacturers are stuck with their surplus vehicles. They can't sell them domestically because the market is saturated, and they can't export them easily due to protectionist policies. This creates a pretty vicious cycle where manufacturers are forced to lower prices even further to try to move their inventory, exacerbating the price wars and financial instability. Moreover, the domestic market in China is also feeling the pinch from economic factors. Slowing economic growth and rising living costs mean that many consumers are holding off on big purchases, like cars. This further dampens the demand for EVs, worsening the oversaturation problem. In addition, subsidies and incentives that once fueled the EV boom in China are being scaled back. The government initially provided a generous financial support to kickstart the industry, but as these incentives wane, the true cost of EV ownership becomes apparent. Without the cushion of subsidies, many potential buyers are reconsidering whether an EV is worth the investment, leading to further declines in demand. Legacy automakers scaling back. Big names like Ford and GM are pulling back from their aggressive EV plans and refocusing on hybrids and internal combustion engine vehicles to recover from financial losses. So first off, let's talk about the financial reality. Developing and producing EVs is expensive. We're talking billions of dollars in investments for research, development, new manufacturing facilities, and much, much more. Legacy automakers like Ford and GM poured massive amounts of money into EV projects, betting big on the future of electric mobility, but the returns haven't been as stellar as expected. Sales have been underwhelming, and the high costs associated with EV production are eating into their profits. These financial losses are forcing automakers to reassess their strategies. Ford, for example, has experienced significant financial strain from its EV investments. The company has openly acknowledged the challenges and is now shifting its focus back to hybrids and ICE vehicles. Hybrids, which combine a traditional engine with an electric motor, offer a middle ground. They still provide some of the environmental benefits of EVs, but without the range anxiety and high costs associated with fully electric vehicles. This pivot allows Ford to stabilize its finances and appeal to a broader range of consumers who aren't really ready to go fully electric. GM is in another similar boat. Despite its bold promises of an all-electric future, the reality has been far less glamorous. GM is scaling back its EV ambitions, refocusing on its profitable truck and SUV segments, which are predominantly ICE vehicles. This shift is a clear indication that the company is prioritizing financial stability over pushing an all-electric agenda. It also reflects a broader market sentiment that the demand for EVs isn't as robust as anticipated. This retreat by legacy automakers signals a broader industry trend. These companies have decades of experience and vast resources, yet even they are finding the EV market challenging. Their pullback suggests that the market might not be as viable or lucrative as once thought. If industry giants with deep pockets and extensive expertise are struggling, that kind of raises serious questions about the overall health and future of the EV market. Moreover, this shift back to ICE vehicles and hybrids is driven by consumer preferences. Despite the hype around EVs, many consumers still prefer traditional vehicles. The reasons are clear: lower upfront costs, greater convenience, and familiarity. ICE vehicles have a well-established infrastructure and a proven track record of reliability. For many consumers, the potential benefits of EVs just don't outweigh the drawbacks. In addition, the scaling back of EV investments by legacy automakers affects the entire supply chain. Reduced demand for EV components like batteries and electric drivetrains impact suppliers and manufacturers down the line. This ripple effect can stifle innovation and slow down the overall growth of the EV market. Hey, if you enjoyed this video, please share and like it, all while subscribing to the channel.